Continuity Conversations on RealAgriculture.com is brought to you by 337. Find out more by going to 337.ca. We're talking today to the CEO and founder of 337, Derryn Shrosbree. Derryn, how are you doing?
I'm good, thanks, Shaun. How are you?
Hey, I'm doing really good. Okay, so Derryn, so far we have talked in our series here. We've talked about, finding out what exactly is this farm worth. Then we've looked at the question of, I think, a really good one. Are you leaving a legacy or are you creating a liability? Now, there are a lot of ways to describe farm transition planning. Some would call it a circus. So maybe it's apropos that point 3 is who is in the tent with you? Who is in the circus tent with you, Derryn?
Exactly. Who's in the tent? So this is a very poignant question. So the circus is, what is the old analogy? Not my circus, not my monkeys.
Yeah, something like that.
But in this case, it is my circus, and the monkeys I want in the tent are, generally speaking, my family or people that I love. So who's in the tent with you is another way of saying something which accountants and lawyers use a lot of, is family trust. So who's in the tent is, when all is said and done, where is this going? All right. So setting up a tent with the people that you want from a transition standpoint is very, very important. So whether that's on farm and off farm, they can both be in the tent with you. They have different seats in the tent, but they're all in the tent with you. It's not like, oh, the on farm kids are in the trust and the off farm kids are not. That doesn't make sense. We can put everything together. What trusts do are very interesting. A trust in this instance is two different kinds of trusts. One is the 21-year trust, which is standard in Canada. Then there's another one, which is not standard, but way more interesting, and it's called a continuity trust. A continuity trust lasts in perpetuity. It never, ever unwinds. Whereas in Canada, there's a 21-year reset rule, which means the trust rolls every 21 years for various reasons. So there's two trusts. Most people have only ever heard of the 21-year reset trust, right? Most people have never heard of continuity trusts. However, they're becoming more apparent because you have a permanent problem and a permanent solution. The permanent problem is each generation is going to die. And how do we protect the bloodline? Right? The bloodline doesn't reset every 21 years. So you can take capital assets and put those into the 21-year reset trust. But the perpetuity trust takes one asset and one asset only, and that's life insurance. And before everyone pours gasoline on themselves and lights them on fire and runs screaming from the barn because I mentioned the word life insurance and everyone hates those words, there is a very specific purpose for that. So that's a continuity trust. That's forever. We're going to discuss that. We're going to discuss the Rockefeller method versus the Vanderbilt. That's over there. But the 21-year reset trust is more simple, and we can discuss that as well. So that's basically the tent, who's in the tent, and what kind of tent do you want? Are you buying a yurt, or are you just going to buy a standard camping tent? It's up to, or do you want both?
Is it trust for everybody though? Because a lot of times I think people like I hear this a lot from our audience where it's like, oh, I got to do a trust, should do a trust, should do a trust. And if you ask why, it's like, I don't know. It really seems like a lot of people are doing it because they were at some sort of a seminar.
Yeah, so no, it's not for everyone. Sometimes the tax implication of actually setting up a capital trust, which is for farm like acreage and plant equipment, et cetera, it doesn't work. It mathematically doesn't make sense. So no, trusts are not for everyone. They definitely aren't. However, we're going to go back to part 1 and 2 of our conversation. With the explosion in the value of farmland, there is a lot more money at stake. So let's say you have 4 kids. All right, how do you protect the bloodline? This is tricky. So let's say you have 4 children, and statistically, out of the 4 children, let's say you with easy math again, $10 million. So the farm's worth 10 million. Each kid, you love him equally, gets about 2.5 million. Let's just use that as the macro, right? Stay in the macro with me. So out of these 4 children, statistically in Canada, 2 get divorced. So there's matrimonial dispute on 2. If you've put $2.5 million by 4 children, there's your 10 million, right?
Mm-hmm.
So of these 2 that get divorced, 50% of their assets evaporate. So 1.25. You've just lost $2.5 million to the exiting spouses. So your net worth was 10, now it's 7.5, right? That's tricky. How do you protect matrimonial breakdown from coming off the acreage and coming after your farm. Right? It's okay, you can pay them to leave, but let's not pay them in acreage because once again, you can't cut the farm up, it's not a pie. Right? So if you want to protect your farm and protect your acreage and protect the bloodline and the generational aspect of the farm, a trust can be a useful tool for you to put assets in to protect you from matrimonial breakdown. So, from a risk perspective, it's extremely important to think about a trust. It might not work for you, but at least to explore the number. Going back to our first part of our conversation, the $10 million example, where you got the $10 million farm, let's see what it costs if your acreage is personally owned, to transfer it into a trust. What's that tax bill? And if that tax bill is not too high, how does it protect from matrimonial dispute? Lots of farmers have 8 children, 6 children, etc., etc. It becomes more and more risky the more children you have, just based on matrimonial breakdown. So who's in the tent? What kind of tent? And does it economically make sense to put the tent up to protect the bloodline?
Well, and how you decide who's in the tent, but you also kind of just we all have different seats, right? So when we go to the circus, we can choose the VIP section, we can sit in the kind of the general admission, or there's the rafters. There's maybe some people are stuck behind a pillar, they can see half the show. We kind of because everyone's not equal in this either, right? In their role on the farm, or because in the worst situations what happens is, what we can do is the older generation is say, well, Mary over here, she's staying on the farm, she's taken care of, right? As if there's no risk to what Mary is doing, right? She's just agreed to take on the risk. Now, there's some wealth in that, but she's also accepted the risk factor of that, which I think is often ignored. Then you have the maybe off farm. We got Rob and we got Ron. And brothers Rob and Ron have their own lives, and have maybe one of them is very successful, another one's a dud, but whatever. How we treat them relative to the on farm child, those are things we got to answer too, and not just who's in the tent, but what seats are they in.
Yeah, for sure. So let's assume that you still Ron and the R's and the Mary are nice people, and the parents will love them, etc., etc. So everyone's in the tent, but to your point, one's behind a bleacher, he can't see much. The other one's got a view of the stage, and then Mary's on stage and she's farming, taking all the risk.
Yeah.
I'm glad you mentioned the risk part because people overlook that, right? It's not, oh, I'm inheriting just $100 million for nothing. No, no, I've worked here for 20 years and I have sleepless nights, and every time it hails, I want to die, etc., etc. So you're taking on a risk. So I appreciate that. So how do we look at, I think the question that you might be bringing up in a roundabout fashion, and I like the tent, it's very nice, is farm continuity. Like the continuity is interesting, but how does on farm versus off farm work? And estate equalization comes into that. So what does the estate equalization look like in this? So you've got, was it Rob and Ron, right?
Rob and Ron, yeah.
Yeah. So Rob and Ron are the off farm boys. How do they get paid? Because mom and dad still love them. They obviously love Mary more because she's on farm. I'm kidding. I'm just
Well, way to feed the stereotype there. That's great.
Yeah, exactly. The stereotype. So the on farm, Mary gets the farm. Happy days. We understand that. Farm is not a pie. Can't cut it up. How do we do estate equalization where Rob and Ron get something? They're not going to get 2/3 of the value because the farm will implode, right? But they got to get something. So what is fair? Don't forget that if you look at it from a continuity perspective, your children, what they get is a bonus. It's not a birthright. Right? It's a bonus. As a parent, if you give your children money or acreage, etc., that's because A, they earned it, and B, because it's a bonus. If your career plan is me dying, that's not good. Right? You can't have that. So if Ron and Rob are duds and they have that as a career plan, that's going to end poorly. But let's assume they don't. So how do we estate equalize? So let's say the farm once again is $10 million. Mary gets the $10 million farm. How much are Rob and Ron going to get? What do you think is fair, Shaun?
Well, Well, a lot of times people would handle that through life insurance,
Yep.
what they get, right?
Yes, that's the easiest. The easiest way to do it is through life insurance. So mom and dad would take out a life insurance policy. Let's say the death benefit is $1 million, right? And then $1 million each. So it's a $2 million policy for the death benefit. And when they die, Rob and Ron get $1 million each. Mary gets the farm. Happy days. Now, we know that that is a easy and wonderful way to estate equalize. But every single farmer I speak to comes to me and says, but the sticker, the ticket is like, let's say it's $100,000 a year. Like it's a big number. It's 100 grand, right? And they're like, now I have to choose. Now they have a thing called opportunity cost. The opportunity cost is, do I choose continuity planning, which is estate equalization, which looks after my entire family, different seats, all in the tent? These are the people I love and I want to take care of them. Or there's opportunity. Or do I go out and buy a new header for the combine? I can't do both because I don't have enough resources.
Yeah.
So what does every farmer choose?
Equal. I don't know.
No, they choose the combine header. They buy
Oh,
a new header for the combine.
yeah,
They
yeah, yeah.
they just do because that's what farmers do.
Yeah, okay, I
So
see.
yeah, so we're stuck in a quandary here. Well, you need the equalization, but you also need stuff for the farm.
Yeah.
So over the last 100 years, people have had to choose. However, now they don't have to choose. They can do both. Because what we can do is we can do the insurance. So let's say it's 100,000 premium, send that to a life insurance company. We can go to a bank or a credit union and borrow back the 100 grand. So we borrow back the 100 grand. We go and buy the header for the combine, and then we write off the interest expense on the loan. Right? So now you still got your new header, so you're making more money on your canola or whatever the case may be, and you've got your continuity plan. So for the first time in history, there is no opportunity cost of dollars because you're using $1 twice.
Hmm.
You've got your continuity plan in place, which means the farm moves to Mary and Rob and Ron get some cash. So everyone's happy and they still have supper together. And yet I haven't reduced the liquidity of your farm because you still have the 100 grand back to reuse for productive purposes on the farm. So that is a very elegant solution to cleaning up continuity and estate equalization, as well as to continue the farming operation unhindered.